Why would someone choose an SMSF over a traditional super fund? What makes it such an attractive option for most people? Traditional super funds may invest in property indirectly, especially through things like trust or real estate investment trust. And SMSF actually allows you own that property directly. SMSFs offer huge advantages when structured correctly, but they require commitment, planning, and the right expertise. Welcome to today's episode of Elevate Your Wealth. If you've ever wondered about self-managed super funds, SMSFs, and how they can actually help you take control of your retirement and your wealth goals, this is the segment for you. We will be diving into why SMSFs are a powerful tool, how they work, and strategies to help you grow your super. SMSFs are not just for the wealthy. They are for anyone who wants to take and have a little bit more control, have better tax efficiency, and have the ability to structure their retirement wealth strategically. So my hope is by the end of this episode, you would really understand why an SMSF could be a great choice for you. So I want you to grab a coffee, sit back, and let's dive into this episode. So let's actually start off with the big question. And the big question for most people is, why would someone choose an SMSF over a traditional super fund? Okay. And what makes it such an attractive option for most people? So we're going to be talking about a few things here. We're going to be talking about 4 big advantages that an SMSF has over traditional super funds. Okay. And the first big advantage really comes down to control and investment flexibility. Okay. So one of the biggest advantages of an SMSF is you actually have control and investment flexibility to certain degrees and as much as you want. Unlike traditional super funds where fund manager selects your investments for you and where fund manager selects your investments for you, an SMSF puts you in the driver's seat. That means you can personally choose where your retirement savings are invested, whether that be in shares, property, private companies, or even things like cryptocurrency. And obviously with cryptocurrency, we say within certain limits and within certain compliance rules as well. So let's talk about control and let's break down what control really means and some real life examples of how people use SMSFs to invest differently from traditional super funds. So we're going to go through about 5 examples here. So the first example is if you want to buy a commercial property because you are a business owner. Okay. So one of the biggest attractions for an SMSF and for business owners is the ability to buy their own commercial property within their SMSF. Okay. This is a game changer. For those who run their own business, instead of paying rent to a landlord, they can pay rent to their own SMSF. That means you're turning a major business expense into an investment. So how does this actually work? How it works is the SMSF purchases the commercial property, okay? And this can be an office, a warehouse space, or a medical practice. And then the business leases the property from the SMSF at market rates. This provides steady income to the fund, but at the same time provides the premises for the business owner to use. What we would see as well is that over time, the property increases in value and all rental income stays within the super environment. And generally, this is taxed at just about 15%. Sometimes it can be low because of things like depreciation and other tax-effective tax-effective deductions within. And when sold as well, once you get to the retirement phase, generally there are no capital gains in the SMSF, especially when that's in the pension phase. So for example, if you run a physiotherapy practice and you rent a clinic space, you could use your SMSF to purchase the clinic instead. This way, rather than paying rent to a third party, your SMSF receives the rent, and that builds wealth inside your super for your retirement. And at the same time, this actually secures your business premise. So, you're not in the hands of the landlord. Now, moving on to another example. So this example is really good for people who want to invest in residential property. Okay. So as we all know, many Australians love property, and while traditional super funds may invest in property indirectly, especially through things like trust or REITs, real estate investment trust, and SMSF actually allows you own that property directly. However, one of the important rules is you cannot live in this or rent out the property to yourself or generally related parties. It must be a genuine investment. So let's look at an example to see how that could actually work. So you could use your SMSF to buy an investment property in a growing suburb of your choice. So once you buy the property is rented out, and the rental income goes back into your super fund, which is the SMSF. Because super tax rates are very low, 15% on earnings on average, it's often more tax effective than owning that property personally. If the property is then held until pension phase, capital gains can be completely tax-free. Okay, so this is particularly attractive for those who already invest in property, especially those that do that outside your super and want to diversify their portfolio within their super as well. So moving on to the third example. So investing in shares and ETFs directly or via fund manager can be one of the ways to actually use your SMSF. Okay. So generally as well, you're not limited to what you do with your SMSF as to how you invest, but you just need to meet the sole purpose test. Okay, so a mix of Australian or international stocks, bonds, property trusts can be invested. But an SMSF allows you to also pick individual stocks and ETFs that align to your strategy or your values. So let's look at how this actually works. So let's say you believe in technological stocks and you believe that this can grow significantly over the next decade, and you really want a direct exposure to that. A direct traditional fund may have some exposure to tech, but in an SMSF, you can actually buy specific shares that you feel are directly related to your values and how you want things to go. Alternatively as well, you might prefer a diversified ETF portfolio, and you want to do this on your terms, or even an international fund. An SMSF can give you access to that. You control when to buy. You control when to sell, rather than relying on fund manager to make those decisions for you. It is totally up to you. So generally, this gives SMSF members their flexibility to adapt their portfolio based on their market outlook and also their risk tolerance. So looking at the fourth example. So in this example, you can invest in private companies or startups. This is another unique feature of an SMSF, because it gives you the ability to invest in private companies and startups, something most retail or industry funds won't allow you to do directly. So let's look at how this actually works. So you might want to invest in a growing private business, whether it's a friend's fintech startup or a family-run enterprise. If structured correctly, and you need to meet the compliance rules for an SMSF then as well, this can be a high growth investment and opportunity for you to take. However, as I said, you really need to ensure that you're meeting the strict compliance rules. So you cannot invest in a business you or a related party have total control over. The investment must be genuinely arm's length to comply with SMSF laws. So moving on to the fifth example, this is when you can invest in alternative assets, things like gold, crypto, and much more. SMSFs also provide the flexibility to invest in such alternative assets as long as it's within your investment strategy. Physical gold or silver held in an appropriate depository, cryptocurrency within compliance rules. While as a financial advisor, I cannot recommend any crypto assets. You, as the trustee of the fund, can actually choose to do so if you please. I always guide my clients to remain very diversified. I always guide my clients to remain very diversified if this is something they want to do. You can also invest in things like collectibles like artwork, but they must be stored correctly and not for personal use. While these investments carry high risk and lots of volatility as well, the ability to include them in a diversified portfolio is a major draw card for investments who want to go beyond the typical stocks and property options, which are just in normal super funds. So, just some thoughts on investment flexibility, especially within your SMSF. So, investment flexibility is one of the key reasons people actually choose to invest in an SMSF. Business owners can own their own commercial property, building long-term wealth while running their business. Property investors can directly invest in residential or commercial real estate. Shareholders can pick their own stocks and ETFs rather than relying on a fund manager. And SMSFs can invest in private companies and startups, opening up unique abilities, as well as alternative assets like gold, crypto, collectibles can actually add further diversification to your fund. However, with great flexibility also comes responsibility. So you need to ensure that your investments align with superannuation account rules and your long-term retirement goals and are documented on your investment strategy. So moving on to the second benefit as to why people actually consider and use SMSFs, tax efficiency in an SMSF. This can actually help maximize returns and help reduce any tax liabilities. So like traditional super funds, SMSF benefit from a concessional tax environment. Investment earnings are taxed at 15%, compared to individual tax rate, which can be as high as 45%. Capital gains are taxed at about 10%, depending on how long you hold the asset, especially if it's held for more than 12 months. And in retirement as well, investment income and capital gains can be completely tax-free. But here is where SMSFs stand out. You can have greater control over tax strategies. So let's break it down for each type of investment strategy we have covered earlier. And then that way you can actually see how you can minimize tax while maximizing wealth in your SMSF. Okay, and we're going to do this with examples as well. So example 1 or 5, so buying commercial property for business owners. Okay, and this can be a smart tax strategy. So we talked earlier about how business owners can purchase their commercial property through an SMSF and lease it back to their business. But then people are then asking, what is the tax benefit of that? So the tax benefit comes because rental payments are tax deductible to the business. And what that means that instead of paying rent to a landlord, your business pays rent to the SMSF, which is your SMSF. The SMSF receives this rental income taxed at only 15% rather than at the business owner's personal tax rate, which could be as high as 30 to 45%. And also, the capital gains on the property, if sold after 12 months, are only taxed at about 10% instead of normal capital gains tax rates. And if the SMSF if you hold this property through the SMSF into the pension phase and you only sell it then, you could end up having to pay no capital gains on this. Okay, so that is a huge advantage when it comes to owning that property. So what can an example look like? Let's say a business owner owns an office and that office is a property inside their SMSF. Let's assume that is for $1 million. Over time, the property appreciates and grows to $2 million. If this property was sold outside super, the capital gains tax could be as high as $225,000, and that's at a 45% tax rate. Inside an SMSF, the tax on the gains is just $100,000 at 10% tax rate. And if the sale happens after retirement, the entire $1 million is actually tax-free. This is why many business owners love using SMSF to own their commercial property. It's a tax-effective way to build long-term wealth while actually running their business. Okay, so example 2 of 5 as well. So investing in residential property. So, this way you can minimize tax on the rental income and capital gains. So for those who are using an SMSF to invest in a residential property, there are similar tax benefits. The first thing to think about is the rental income is only taxed at only 15% compared to personal income tax rates, which could be much higher, as we said earlier on, as high as 45%. Interest on the loan, which can be gotten through a lending institution, is also tax deductible to the SMSF and provides gearing to the fund as well, which is an added advantage. In my opinion, the most beneficial to non-business owners is actually being able to gear, or just anyone that has an SMSF, is the gearing as well within this that can help you grow your funds. If this property is held for more than 12 months, any capital gains on the sale is taxed at 10% instead of 22.5 to about 45% in your personal name. And if the SMSF, if the property is held through the SMSF until pension phase, there are no capital gains and everything is completely tax-free. So let's look at an example as well. Let's say you buy an investment property inside your SMSF for $500,000, of which lending institutions can actually give you $400,000 of this amount. Over 15 years, it can appreciate to, say, $1 million. And if sold while in the accumulation phase, the capital gains tax is only about $50,000. Okay, if sold in pension phase, you can keep the entire gain tax-free. So this makes an SMSF an attractive vehicle for long-term property investment, especially if planned strategically. And this planning can be done around retirement when you buy and ensuring you hold assets for the long term. Okay, so relating this benefit of tax deductibility to investment in shares and ETFs as well. With an SMSF, you can really optimize tax on dividends and franking credits in ways that aren't possible in a normal retail or industrial fund. So dividends are taxed at only 15%, making high dividend stocks even more attractive to be held within your SMSF. So franking credits from Australian shares, and generally let's assume these shares are fully franked, can offset SMSF tax liabilities, sometimes even leading to tax refunds, okay? Because the companies would have paid a certain tax, but you in the SMSF will pay a lower tax, so you get a refund. Capital gains from shares held longer than 12 months as well are taxed at a lower rate compared to if this was done outside. So let's look at an example. Let's say you hold about $200,000 in Australian shares, paying franked dividends of 5%. That's $10,000 per year in dividends. But because of franking credits, the SMSF could pay little to no further tax on this income, or even get a refund from the ATO. That means an SMSF investor can keep more of their dividend income compared to an investor holding the same shares in their personal name. So for investors focused on income-producing assets or corporate executives that actually have large holding of shares, SMSFs provide significant tax advantages over direct investing. So now let's look at an example where you're investing in a private company, okay? And for SMSFs, that investment in private businesses can offer unique tax advantages. If the private company distributes dividends, they're taxed at only 15% instead of on the personal tax rate. And very similar to holding normal shares as well. If you hold these investments for more than 12 months, you actually get an added capital gains discount, which would be a lot lower than if this was held in your personal name. While investing in private businesses through an SMSF is more complex, it can be and bring lots of tax efficient ways to actually build wealth and grow more if you cannot do that in your personal name. Generally, small businesses grow at a faster rate than large businesses, but these come with more risks as well. So looking at the last example in terms of alternatives or collectibles, SMSF also offer tax advantages for alternative assets like crypto, gold, and collectibles. And same thing for cryptocurrency, so if this is held in your SMSF for more than 12 months, this is actually taxed at a lower rate if sold compared to holding this in your personal name. Okay, so just to recap in terms of tax efficiency, tax efficiency is one of the biggest benefits of having an SMSF. Okay, so holding things like commercial property, investments, private businesses, cryptos can offer lots of tax advantages and help you build your retirement wealth over a long period of time. So next, we're going to move into pulling super balances and what is the benefit of actually doing this. So pulling super balances together, this is the third benefit of the 4 big advantages we're talking about. So this can ensure that you pull balances together and then actually you can access more debt, or you can actually buy investments that are larger than you would have been able to do by yourself. So this is unique to an SMSF because unlike retail or industrial super funds, you cannot come together as a group of 4 to about 6 people and put your funds together to work together. So this can work in terms of doing it with family members or doing it with business partners or just doing it with friends who you can actually work well and invest together as a unit. So why does this actually matter? It matters because higher balances, combined with actually use of smart debt can actually give you opportunities to better investments. You can actually improve diversification within the fund. I know there are lots of actually cost savings in terms of putting your funds together to work as one unit. The key way SMSFs maximize their investment potential is by leverage. And you can do this through something called a limited recourse borrowing arrangement, LRBA for short, where SMSFs can borrow up to 80%, sometimes even higher, of the loan to value ratio to purchase assets like commercial or residential property or any other assets, as long as lending institutions are happy to lend them. However, one crucial factor many SMSF investors overlook is actually liquidity. The ability to meet ongoing costs, the ability to ensure that investment risk reduced, and pension obligations if members are in the retirement phase or close to retirement. So what that means, a well-structured SMSF should ensure it has some liquidity, sometimes up to 50% of the total super balance fund should be in liquid assets. Okay, so you don't want to put all your assets into property. This ensures your portfolio can withstand any rocky periods and you're not selling at the least opportune time. So let's look at the examples. So buying a commercial property, using some debt and pulling funds together. Okay, so the best way to look at this is through scenarios. So a single member fund SMSF versus a pooled member fund SMSF. What does this actually look like? Okay, so when we think about a single member fund SMSF versus pooled fund, you'd see that there's a huge difference. So let's assume a single member has total balance of about $300,000 and they want to keep 50% liquidity and they're happy to use the other $150,000 as a 20% deposit. So what happens there is they're able to get a loan of about 80% on that, which means the bank can give them an additional $600,000 plus the $150 they have as a deposit. They can buy an investment property of roughly about $750,000. Okay, so that would get you an average house across Australia, depending on where you live. While as if the funds were pooled together with 4 other members that had roughly the same balance, all of a sudden they combined have $1.2 million, 4 members, of which they can keep $600,000 into liquid assets, and they can now use $600,000 as a deposit for property. So with the bank, with a lending institution, I'm happy to give them 80% of that. They can borrow 2.4 million plus your 600. They can now buy a property, generally a commercial property of about $3 million. So as you can see, that is the difference in terms of, pulling funds together. You can access and buy bigger assets versus doing it by yourself. So what are the key takeaways? More members equals to bigger deposit and equals to bigger borrowing capacity. Generally, with more members as well, and let's assume you want 50% liquidity, that actually allows you to invest in a diversified fund and have enough liquidity in the SMSF. And the business pays rent to the SMSF if you're buying a commercial property, which helps fund the loan repayments while keeping cash flow stable in the SMSF. So let's look at the second scenario where business owners are buying their own commercial property through an SMSF. So let's say a family business owns a manufacturing warehouse, and they actually want to stop paying rent and own the premise which they work in. Let's assume they have 4 SMSF members, and each can bring about $250,000. This creates a $1 million fund. The SMSF can then borrow 80%, which would be roughly about $2 million, okay, from a lender, bringing total purchasing power to about 2.5 million. Okay, so the business rents the warehouse from the SMSF, paying market rent, which flows back into the super fund at concessional tax rates. Now the leftover $500,000, which was 50% of the total balance, is retained as a liquid investment. And then that way, it really ensures that the SMSF can cover any unexpected costs or expenses. And, they can actually pay out any future pensions if there's anyone in the retirement phase. So why is liquidity essential in an SMSF as well? Generally, it just ensures that the SMSF can cover interest payments, even if rent payments are delayed or if rent payments don't cover the full mortgage repayments. Also protects against the property market. Sometimes there might be downturns and where selling may not be an option, so that way you can actually still ensure you can make repayments. It also avoids forced sale, in situation where members need funds for retirement, then you don't have to sell down this huge asset, but you have funds in there. So now if we look at the next example of, someone investing in a residential property and using some debt as well and ensuring that, they can actually have a high growth asset, but maintain liquidity. Okay, so let's talk about a scenario where there's a single member in an SMSF versus a pooled SMSF, and they want to use debt. They want to ensure they have liquidity, but at the same time, they want to buy residential, property in there. And this is very similar to the example we just spoke about before now, because if there's a single member with $300,000 versus pooled members with about $300,000 each, what happens is the pooled members can actually buy a bigger residential investment property and actually do that versus if they went and set up an SMSF by themselves. And so the key takeaways are very similar to when we're talking about a commercial property. Larger SMSFs can invest in higher growth suburbs or just better suburbs, because generally with the better suburbs, you might need to pay a little bit more. And then that way you get better long-term returns. With more members as well coming together and buying a residential investment property, there is more liquidity in the fund. And then that way they're not in a situation where they have to force sell or in a situation where they need to contribute a lot more money. One good thing as well is you can then leverage more when you put your funds together, and then that way you actually ensure that you have enough cash to get what you want and then get a high quality asset. Okay, moving on to the next example. So this is where we talk about how an SMSF can actually reduce the overall cost. A big advantage of pooling balances is that it reduces the cost per member while ensuring enough liquidity to handle unexpected expenses. Many SMSF expenses such as accounting, legal fees, financial advisor fees, and audit fees are fixed. So what that means is that with the more members you have, the lower the individual cost to all the members. So if we look at a scenario, an SMSF with one member versus an SMSF with 4 members, what does that look like? So let's assume the individual member has about $300,000, and let's assume cost for that is about $4,000 in terms of ongoing management of the fund. That's roughly about 1.3% of the balance. But if you then have 4 members with $1.2 million, and let's say the ongoing cost is still $4,000, that's 0.33% of the balance. So the key takeaway there is, if you have an SMSF and if you have multiple members in there, you actually have the ability to reduce the cost because more members means lower individual cost for administration purposes. Okay, so what are the final thoughts on pulling super balances together and ensuring there's enough liquidity in your SMSF? So pulling funds definitely allows you to have a lot more members, allows you to have a lot more leverage, gives you access to better investment opportunities, and it also reduces cost. So it's a key thing to think about when you actually putting all funds together. A well-structured SMSF allows and ensures that there is enough liquidity to cover short-term needs, and also maintain loan repayments and avoid selling assets at the wrong time. If you're considering setting up an SMSF, investing in property, or using leverage inside super, make sure to get professional advice. This is a high-reward strategy, but it must be structured correctly to ensure financial stability. So next, let's dive into estate planning in SMSFs and how to ensure wealth is passed down efficiently. And this is the last benefit that I want people to think about when they're actually thinking about setting up an SMSF or if they already have one. Okay, so this benefit really comes down to, estate planning and legacy benefits for you and your family or your loved ones. One of the biggest advantages of an SMSF is the ability to control how your wealth is passed down. Okay, unlike retail super funds where trustees make the decisions, an SMSF allows you to structure your estate plan to benefit your family while minimizing tax. So now let's explore how estate planning works for different types of SMSF investments. We're going to be covering a few aspects. So we'll cover commercial property, residential property, shares, and private businesses. And, this is to really ensure that you have thought about, okay, if this is going to be beneficial for you and how estate planning actually fits into the whole financial plan you have. So the first example, we'll talk about estate planning for commercial property in an SMSF. And we'll use this, or rather, I'll explain this using an example. I think that's the best way for people to understand this. So a family business that owns their commercial premise, and we'll use an example of a mother. We'll use an example of a mother and a daughter who run a business, and the SMSF owns the warehouse they operate from. When the mother passes away, the property needs to be transferred to the daughter. However, the daughter is not a member of the mother's SMSF. So a direct transfer within the same fund is not possible. So what are the options and how can we actually transfer the asset so it works in favor of the family and the business? You can do an in specie transfer from the SMSF to a family trust. And all this really comes down to, what the estate plan was. The SMSF can transfer ownership of the warehouse as an in specie lump sum benefit payment to the mother's family trust. And if structured correctly, this can be very beneficial. This really allows the asset to stay within the family, stay within the family's control, rather than being sold to an external party. The family trust as well can then lease the property to the daughter's business. And what this does, it really ensures business continuity. Okay. So another option as well is an in specie transfer to the daughter's SMSF. Okay. Let's assume the daughter owns her own SMSF. She may be able to purchase the property from her mother's SMSF or estate. And that way she's using her super as the balance, and she can also borrow and have a limited recourse borrowing arrangement in place to make this happen. What does this do? This really keeps the asset inside the superannuation account system, ensuring continued benefits, and also ensures that, there's long-term control and the asset stays within the family business. So the SMSF receives the proceeds from the sale, which can be used for other distribution to other members or other beneficiaries that should have benefited from this asset in the mother's estate. So there are also key estate planning considerations to ensure you are thinking about. So you want a plan to avoid any forced sale. So planning this transfer in advance ensures that the property stays in the family's hands, and rather than just being liquidated and them having to lose that property. It also helps with some tax efficiency. If structured properly, this can be done without triggering any capital gains or excessive tax on withdrawals. One of the key things as well is maintaining that business operations without too much disruption. So the daughter's business can continue leasing the property, and then that way it just ensures that there's smooth operations and financial stability within the business. So another thing to think about as well is liquidity planning. The SMSF should have other liquid assets, things like shares, ETFs, or bonds, to avoid financial strain while transferring the business property from one SMSF to the other or within the estate. Why does this really matter? It allows business owners to pass down commercial property, tax efficiently if possible. It also ensures business continuity for the next generation, and it also prevents estate disputes and forced sales if you've documented and have all these things in place. So moving on to example 2 of 4. So estate planning for residential property in an SMSF. So estate planning within an SMSF isn't just about passing down wealth, as I've mentioned before. It's about doing it in the way that preserves your assets and actually minimizes tax. And now we'll focus on parents who want to transfer an asset within an SMSF and transferring that to the kids in a tax effective way, either while they are alive or after they pass away. So the different options we can look at in this regard. So we can look at the first option, which is the early inheritance route. So, this really depends on what the clients want. But early inheritance, while parents are in the pension phase, once the SMSF members reach, that pension age, which is age 65 plus, or once they've reached the full retirement, when they've met the full retirement condition, generally 60 plus, and while that's important, or rather why that's important is at that age, whatever you earn in your SMSF is actually tax-free, which is good. And that's a great opportunity for parents, if they want to pass wealth down to the next generation, can do it effectively. So why early inheritance can be tax effective is because withdrawals within the SMSF in the pension phase are tax-free, which means that, parents can gift cash to the children without triggering extra tax. Instead of leaving properties inside super, parents can actually move them out tax-free in the pension phase and then pass this or the proceeds strategically on to the next generation. Another key thing as well is that this reduces the super balance, lowering the future tax burden on non-dependent children. And if you've more than your transfer balance cap as well, it actually reduces that below to the tax effective level. So if we look at an example, what can an example look like? So a couple owns two investment properties in the SMSF. Let's assume the properties are worth $2 million. And they decide to sell one while in the pensions phase, receiving $1 million tax-free inside your super. The different ways they can actually then move this money out. But let's assume they withdraw $500,000 as a lump sum and then gift it to their children while they're still alive. And the remaining $500,000 can stay in their SMSF to ensure that they have enough funds for their retirement. The key benefits there is the kids receive part of their inheritance early without paying any super-related taxes on withdrawal of these assets. And I think that's a very good advantage for both the kids and both the parents, if the parents can afford to do that. Second option as well is transferring the properties after death. Okay, so tax contributions need to come in place if parents don't withdraw assets while still alive, because their children will inherit the properties upon them passing. However, adult children are not tax dependents, which means a tax of up to 17% or more may apply on the taxable component of the super fund. So what that means is that the kids may not get the full property, or they might have to pay lots of taxes once the parents pass. Why does this actually matter? So if properties are sold inside the SMSF before payouts, they may still attract payments if the ultimate beneficiary is a non-dependent for tax purposes. If properties are also transferred to the kids as an in-specie transfer, the super fund there might still have to pay some taxes, especially if they're non-tax dependent, and this is after the parents have passed. While as if they did it before, there are no tax benefits and there's actually more money for the kids. If there wasn't enough liquidity in the fund, children might be forced to actually sell the properties before they can keep anything that is left, depending on how much the estate is and what is passed on. So if we look at an example now, so let's assume parents pass away, leaving $2 million in properties inside their SMSF. The key issue there is if the SMSF holds only one property and no other liquid assets, if the SMSF holds only properties and no other liquid assets, the kids might have no choice but to sell, and even if they want to keep these properties. So what's the solution there? It's definitely around liquidity planning and, avoiding a forced sale. So this, how can we do this to ensure the kids can keep the properties? So the parents should withdraw and distribute assets tax-free in pension phase where possible. I said there's a huge thing to consider. Are they going to have enough for retirement? And, no one knows exactly when you're going to die. So that's a key consideration. They also want to maintain enough in the SMSF to ensure the liquid assets. So that's why we always say hold some shares, some bonds, some ETFs. And that way you can cover any other taxes that come up, or ensure you can take care of yourself if this was to be passed on. With the right strategy as well, SMSF investment properties can stay in the family without unnecessary tax or forced sales. So if there's a certain asset you still want to keep in the family long term, that is one of the ways to actually do this. So now moving on to estate planning for shares, ETFs in an SMSF, or even private equity holdings and other alternative assets. Okay. So an SMSF allows a lot more tailoring than a normal super fund will do. And using an example is that let's assume you want to pass down a specific share portfolio and you want to do that tax effectively. And let's assume a couple has $1.5 million in the SMSF, with 50% invested in shares and ETFs, and they want to ensure that these specific investments are passed down to their children in a structured and tax effective way. So an SMSF provides such flexibility and control that they can do that. And this is more flexibility and control than you'd have in a standard retail or industry super fund. So what, or rather, how can you do this? In the SMSF, the couple can create a binding debt nomination. Okay, that ensures that their super is distributed exactly as they wish. And whether that is directly to the children or through a family trust, all that can be specified in the binding debt nomination along with your estate. In a retail or industry fund, the super trustees have the final say. And generally, this is only done if you can even make a binding debt nomination, because sometimes it's a non-binding debt nomination. And what that means is the trustees then decide where the money goes and who gets it, and you don't have as much flexibility and control. Another thing as well, the ability to transfer the shares without having to sell them. In an SMSF as well, instead of selling investments and incurring capital gains, depending on when you sell and how you sell, they can actually pass down these shares in specie transfer to the children. And I guess this is really important if you sell it in collectibles or assets you want to pass down, or just private shares in a private company. Generally, in a retail or industrial super fund, they would have to sell down the funds to actually distribute this to the estate before such money can be distributed to the required beneficiaries. There's also tax benefits. In an SMSF, the couple can plan withdrawals, as I said, while still alive. Let's take advantage of the tax-free pension phase, or they can recontribute money if they have into super within certain limits and concessional contributions. Within certain contribution limits to ensure they have moved some from a taxable component into a non-taxable component. So another good thing as well is a couple can really use family succession planning to ensure gradually that they bring the children into the fund and allow them to inherit and manage these assets within the SMSF. This is very hard to do and actually impossible to do in a retail or industrial funds, because, children cannot inherit the super account itself, and funds must be paid out as a lump sum or as an income stream, potentially forcing these assets to be sold, potentially forcing the assets to be liquidated. So what are my thoughts on SMSF estate planning? Okay. Estate planning in an SMSF ensures that your hard-earned wealth is really passed down according to your wishes. And also you can do this in such a way that you're minimizing tax and ensuring you meet liquidity issues to ensure it's done when you want and how you want. So just to recap a few things, for business owners, SMSF prevents forced sales of a strategic commercial property and ensures business continuity. For property investors out there, SMSFs really allow rental properties to stay within the family if you want that to stay. And then for share investors, SMSFs ensure tax-efficient transfers without capital gains taxes. So such assets remain in the family. And moving on to, private business owners and for other specific alternative assets as well, SMSF usually allows such assets to be transferred directly to the beneficiaries. So a well-structured SMSF estate plan really protects your legacy and ensures that your family benefits from your wealth in the most tax-effective way possible. So if you're thinking about estate planning within an SMSF, or if you want to ensure your super is structured correctly for future generations, let's chat about it and we'll be sure to guide you as to the next steps. So up next, we will discuss advanced strategies for boosting super balances using contributions and gearing strategies. So don't miss out. Stay tuned for the next episode. So we've covered a lot today, how SMSFs provide investment flexibility, how they help with tax efficiency, the ability to pool super balances together with business partners or family, strong estate planning benefits of an SMSF, but an SMSF isn't for everyone, So let's wrap up with a quick reality check on who should and who shouldn't consider setting up an SMSF. So, who should consider setting up an SMSF? SMSFs can be a powerful wealth building tool, and generally, this can be very good for business owners who can own commercial property in the super and lease it back tax effectively to themselves. This is also very good for high income earners who can use tax strategies to build more wealth efficiently. This is also good for property investors who can and want to invest directly in residential and or commercial property using SMSF borrowings. And another group as well is professionals and executives who can really structure investments to manage tax and long-term wealth creation. One other group as well is family, close friends, or business partners looking to pull super together. That way they can combine super balances to access higher value investments and actually reduce costs. So who shouldn't consider an SMSF? So an SMSF may not be the right choice for people with less than $200,000 in their super, okay? And why is because SMSF setup and admin costs can outweigh their benefits for smaller balances. It still can make sense for people with low balances, especially if you are a business owner or if you have large wealth outside super. SMSFs as well are generally not for hands-off investors. If you prefer a set and forget approach, and an industry or retail fund may be better for you. And a last part as well is those unwilling to meet compliance requirements and compliance requirements, as SMSFs can come with annual tax returns, audits, and ATO regulations. So not everyone wants this responsibility, and those that don't want it need to ensure do not set up an SMSF. So final thoughts and call to action for today. SMSFs offer huge advantages when structured correctly, but they require commitment, planning, and the right expertise. If you're thinking about setting up an SMSF and want to review or just want to review your current strategy, make sure you get professional advice. If you have questions or want to explore whether an SMSF is right for you, reach out to me. I would love to help you structure your super to work in your favor. That's it for today's episode. Thanks for listening. If you enjoyed this, don't forget to subscribe, leave a review, and share this with anyone who might benefit from learning about SMSFs. So until next time, remember, your super is your future, so take control and make it work for you.